Okay, you're very welcome to another Coffee Microcaps Fund Manager interview, and I'm delighted to welcome back Gregg Taylor from Salter Brothers Emerging Companies Limited and the listed LIC. Greg, welcome back.
Thanks, Mark. Good to see you again.
Yeah. Hat trick of appearances here for Greg today. He's been on with us twice before over the years, and got two interesting stocks. Ones we haven't actually talked about with some of the other managers in the last couple of weeks. We've been doing a few of these interviews, but again, the wide array of stocks that you can get in the microcap space, we still haven't managed to cross over with any of the other fund managers who've been on here, which is good. But Greg, before we start, maybe just if anybody hasn't come across the lick before, maybe just give a kind of a brief overview of the LIC and kind of what you guys are invested in.
Yeah, absolutely. So the LIC is under the code SB2, so it's Salter Brothers Emerging Companies Limited. We're a dedicated microcap fund, really. The mandate is for ASX listed companies under $500 million market cap. So we live and breathe this market throughout the cycle. So very dedicated in that space. And quite a concentrated portfolio, circa 25 stocks, and roughly about $100 million portfolio size. Bit of a unique characteristic is, or it's not that unique really, I guess, in the lick world, but the underlying post-tax NTA versus the current share price, it sees about a 35% discount. So you can get this diversified portfolio of microcaps, at 35% off the daily price. So, but more importantly, what do we invest in? We invest in industrial companies with more of a growth focus, very valuation focused. We tend not to invest in resource companies. So, uh, the old terminology of growth at a reasonable price probably best sums up what we do. But looking for strong management teams, unique, defendable intellectual property or some sort of moat of the business that gives it, an element of pricing protection, if not pricing power, and you're backing good management teams, supported by some good earnings growth, a strong balance sheet, and again, very valuations centric and focused. So we're not sort of growth at any cost. We're looking for mispriced growth in that microcap market.
Okay, and we got two microcap stocks for us this morning. One actually has been kind of a regular presenter with us here. Coffee Microcaps actually presented at our in-person conference in Sydney back in May. Was I think the last time there people from Coffee Microcaps would have seen them, which is Worker for maybe anybody who hasn't come across the stock before, Greg, maybe just give an overview of kind of what they do. They've probably come into contact with Worker maybe without knowing it, maybe. It's quite embedded across the kind of super industry, but the name itself probably wouldn't pop into most people's minds.
Yeah, absolutely. It's one of these typical enterprise software businesses that typically operates as a white label solution into bigger organizations. So touches millions of Australians daily, but you wouldn't necessarily know it. But at its core, what it is a HR technology business. And there's a lot of those around, and in many cases, people might think it's a crowded space, but that they do the full range of HR tech solutions from sort of recruitment and onboarding of staff, but very much more of a focus on compliance and the processing of superannuation payments, which has really been the key driver for this business and the differentiator around what it does. So it's a HR tech business, circa $170 million market cap, uh, achieved remarkable growth, but still relatively unknown and not well held across the institutional market. But where its real leg of growth is coming from is this payday super regulation that's coming. But I'll go into that in a bit more detail. But it's got some really good technology, some great customers, and some embedded growth within that customer set. But it's got some nice tailwinds behind it, being driven by regulatory factors.
And yeah, maybe if we just just talk about that or expand on that, is that kind of the main attraction for you? Is we people mightn't be aware of it, but there's been a lot of talk about payday super, and essentially what the government is trying to do is instead of this lag effect of you get paid every week or fortnight or monthly, whatever your kind of pay schedule is, but your super actually, while it might be deducted, won't be paid over by the company for a month, 2 months, even a quarter. But kind of what happens is, companies go into administration, liquidation, and then there's like super that hasn't been paid, and kind of the government is kind of sick and tired of filling that gap. So what's going to happen basically under payday super is you get paid, your super gets paid across to the super fund on the same time. But the background of what has to happen for that to actually all take place seamlessly is quite a technological process, and Worker is at, I guess, the forefront of enabling that, interconnectedness between the employers on one side and the super funds on the other side, plus the banking and financial institutions that say in the middle of all of it.
Yeah, absolutely, Mark. And so, yeah, really at its core, it's something that's been spoken about for quite a while. But come July 2026, it's regulated, and so you need to be paid your super at the same time you paid your salary. Whereas formerly the regulation was super was to be paid quarterly um, at a minimum, but the compliance around that has been pretty loose, and so there's a big push from regulatory bodies to ensure not only the more frequent payment of the superannuation, but also the ongoing compliance and monitoring. So what that's causing is a lot of these big employment groups, predominantly a lot of the super funds. The big employers. So think of Rest Super, Australian Super, big, which got several million people staff base that will utilize this software. And Workers positioned itself really well with a leading global technology that enables that to happen, via an app. And not only can the worker and the enterprise use it, but also, yeah, the employee can also access and monitor it very neatly as well. So that's the big driver. And again, we're fortunate enough to, again, classic sort of microcap story where this regulatory change was on the horizon but wasn't well known, and Worker was talking about it but was going through a number of pilots trying to prove its wares and win a couple of these big contract opportunities. They started speaking about this target of getting to a 7 million user base over the next sort of 3 years. And the market decided to sort of wait and see, and they went through a few of these pilots. But over the last 6 months, they've got some real traction around those pilots and have been successful and have onboarded those into contracts. Um, and so that's been a big driver of the growth. And yeah, to put that into perspective, we've got a business that we genuinely, believe can, it's growing revenues at, a remarkable rate, like over 300% a year off the back of these contract wins. So you're sort of going from a single digit revenue pretty quickly to 30 to $90 million of revenue and becoming quite profitable. And it's, still just in the early part of that curve. And actually why it's quite topical is only yesterday it went into trading halt to raise an additional $15 million of growth capital uh, to 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 feed that growth. But the good thing is that it is on in that tipping point of going into profitability off the back of that revenue growth. Um, and like a lot of these enterprise clients, there's a sort of you win the contract, but there's a 6 or 12 month lag until they're all onboarded and you get the full impact of these revenues and earnings. And look, based on our what we think are very conservative numbers, this is a business that'll get very close, if not through $100 million of revenue by FY 27, and which will see it trading on a low single digit PE. We're talking sort of 4 times PE multiple looking out, 18 months. So very attractive. Still a lot of upside in our mind. And to that extent, and I don't say these things lightly, but we were fortunate enough to get into this stock at an average price of around 3 cents. It's trading at about 9 cents. We actually put considerable additional money into the capital raising yesterday, such is our conviction. But we genuinely believe over this next 2 year period, this stock is worth 30 cents every day of the week, which is more than 3 times where it's trading today. So what you're seeing is a lot of the more traditional small cap managers who have been a bit late to the story, trying to get exposure um, to this opportunity. And we think it's going to be, there's a lot of catalysts coming as well. There's a lot of contracts that are in the late stage of negotiation with. There's an opportunity with the ATO as well around helping them with their compliance and onboarding of a large customer set as well. So catalyst rich, not well held, amazing growth ahead of it, and still quite conservatively valued. So and a great management team. So it really ticks the boxes of what we look for in our portfolio, and it's sincerely one of the top three conviction names in our portfolio at the moment.
Yeah, I think one of the things from when Trent Lund, the CEO, was presenting at the conference in Sydney, one of the things that hit home for me was that this move from, let's say paying super on a quarterly basis to in line with your salary is, especially if you work in some of these like enterprise kind of bargaining groups, so like tradies in construction or nurses or stuff like that, where you know, worker clips a fee every time, one of these instructions is sent across, not to mind, the software license fee. So I kind of said to Trent, well, surely everyone who's paying weekly is going to immediately flip to monthly because now they're going to, they're going to be seeing these fees coming through all the time. And he was like, well, you can, but for a lot of the tradies and stuff, it's like regulated that you get paid on a weekly time scale or a 2 weekly time scale. So they actually, if they try and reduce the cost, a lot of the times it's like, not doable. It's like regulatory imposed that this is the pay cycle for people in this industry. And that kind of was a real insight, I thought, for me of like, what the revenue potential is, and that there's, for a large, because they have quite a few of the industry super funds on board, that, the employers in that thing, there isn't really much they can do to, bring down the costs when it does actually kick in.
Yeah, no, absolutely. So, yeah, it feels like of the contracts they've won and off the back of the regulatory change, there's not a high degree of risk around that growth profile, and there is upside to it. So, no, a real opportunity to become from a $200 million company to a 500 million, and it has every chance to be a billion-dollar company with the opportunity set ahead of it over the next five plus years. But we'll be happy with it getting to 30 cents over the next couple of years, that's for sure.
I wanna throw one spanner in the works and jinx here. Now, we were talking offline, Greg, before we came on here. Does this get taken out before we, see its like full potential? Because I could, for uh, a few of the bigger financial services players, does this get kind of swallowed up into one of the banks, into, a larger fintech business? I'm trying to think of there was another kind of super administration business a few years ago.
It
The name
was, yeah.
escapes me. That just as it was kind of really kind of getting going, it got snaffled up by a larger kind of industry player.
Yeah, no, it's a real risk, and it's a pretty open register. So, but Trent, as you mentioned, who's the managing director of this business, I know he shares a similar view to ourselves around the current valuation of this business, and think there's a pretty loyal set of shareholders that are aligned with him. So hopefully it doesn't get stolen off the ASX like many before it have. And but without question, with you get any enterprise software business that touches 10 million Australian workers, and then big part of the growth I haven't spoken about is that payday super is critical, right? And it's the driver, but the opportunity with once you're touching all those workers is to offer other products, and generate more than just the super payment revenue. So that sort of land and expand opportunity is significant. But to your point, that customer set that they'll be connected to will be extremely valuable, and other broader financial players will have other products that won't be wanting to try to put in front of that user base. So real risk of that, but yeah, we're pretty optimistic that the current shareholder set will defend its position for at least another 100 or 200%, and then we'll see what happens.
Yeah, let's hope so, and hopefully we can get yeah, Trent back on. Yeah, once he's kind of finished up with this capital raise and
Yeah.
the result is out. If we maybe move on to the second one, a business been around for a while, had a rough time of it post-COVID, but looks like it's kind of after getting its mojo back, especially in the last few days even. Eroad, New Zealand enterprise telematics business.
Yeah, no, it's an interesting one. And again, we were talking offline prior that it's one that we've followed and invested in, over the last 5+ years, or even longer actually. And I was lucky enough to make a pretty healthy return on it, sort of 4 years ago. And at its core, what it again telematics, but for the for the generalists out there, what it is, it's hardware and software within logistics fleets or cars, transport. Um, Vehicles that it monitors usage, compliance, and safety and efficiency and many other things. So at its core, think about a device that's simply like a toll road, monitoring, your e-toll sort of tag. Think of that with a lot more functionality. So this is as you touched on, a New Zealand business that it's got a very strong, close to 80% market share over there, but has done a great job of expanding globally. So it's really making an impact in Australia, but also in North America as well. And so its technology works not only in the cabin, i.e., where think about a truck driver, how many kilometers are they doing? Are they getting rest? Are they speeding? Are they, all those compliance things, or even paying their road tax, user tolls, and all those sorts of things? Uh, it does that, but also, and where they've really forged out a niche in the US market, the North American market, is in the refrigerated transport sector as well. So this technology not only monitors where you're going and how fast and makes payments on the way, it also can do things around monitoring temperature and how long food and other perishable products within a cold storage is operating. So some really encouraging headway in that North American market. And I was recently over there actually. They're based down sort of south of Los Angeles towards San Diego there, and spent some time with management really understanding that opportunity. And it's significant, right? I think we're really only in the early stages of that. So again, great, genuine global business. Again, business that's sort of on track to do $200 million of revenue. So it's profitable. And really entrenched user base, and got some nice regulatory tailwinds behind it. And and it was a sincere, Mark reached out, in the last couple of weeks and said, "Have you got a couple of stocks you want to talk about?" And obviously we need to prepare the presentations, a week ahead of it in advance. And we spoke about Eroad, and in the last couple of days, it's up 30-40%. And what's happened there is that. within New Zealand, where it's got the most dominant market share, typically governments used to raise money from and for roads and for people using the roads by a fuel excise. And so I think fuel taxes and everything else. As we're now in this age of electric cars and everything else, that's not as powerful mechanism and not as fair a way to do it. And so a lot of governments around the world are thinking, well, what's the best way to put a levy on users of the road? And so now they're doing this via monitoring of the cars. So uh, it's called the Electronic Road User Charging Mechanism, or ERUC. And so, what the New Zealand government actually mandated that in the last week. Again, something's been spoken about for a while, but was actually mandated. And with an E-Road with 80% market share in that market as the dominant provider of those solutions, uh, the expectation conservatively is that's at least an additional incremental $100 million revenue opportunity over the next few years for E-Road. And yeah, again, that's off a $200 million current revenue base, so meaningful. And again, these things are typically quite sticky revenues, long dated, and increasingly software opposed to hardware driven, so at really attractive margins. So that's why the market's sort of woken up out of its slumber over the last well, few days, but few months. But again, we were fortunate enough to, again, I go back 5+ years ago, we built a position in this stock under $1 and it went up to $5. And
Mm.
we were lucky enough to sort of lighten and exit that position. And as Mark touched on, it had some challenges and came all the way back down below $1. And we rebuilt a position knowing the strength of the technology and the model and some of these regulatory tailwinds on their way. And yeah, and so really encouraged by the recent movements, but it's still a top five holding in our fund and still significantly undervalued relative to its enterprise software peers on the market. So again, highly profitable business, but it trades at about half the multiple of most of the ASX peers of similar characteristics. And you hear about this rule of 40 that a lot of people focus on in software or growth investors, which is the combination of the EBITDA margin as well as, or the EBIT margin as well as the revenue growth, at its most simple level being greater than 40% each year. There's not actually many companies on the ASX that tick that box. Eroad's one of those. And just the other ones that do tick that box trade on 2 and 3 times the multiples that Eroad does even after its recent bounce of 30-40% this week. So we think it's mispriced. We think it's a really strong business. New management did come in. So as Mark touched on, they had some challenges 3+ years ago. New management teams come in. We think doing a great job, and that gave us the confidence to step back into the stock. And yeah, it's one that suggest people keep an eye on because yeah, if it starts trading in line with its peers, again, it's got well north of 100% upside from here.
And I think, yeah, one of the challenges, which I mean wasn't really a self-inflicted wound, if I can say that, was the big capex spend that they've had to do over the last 2 or 3 years with the switching off of 2G and 3G
Yeah.
networks, which powered a lot of the little the little things the little monitors that sit in the cabs, which required a huge, which depressed the earnings temporarily while they were like recycling through like all of these things and getting all their customers up to a 4G unit. So that has been a challenge for them, but not one of their kind of own making. But they're just coming to the end of that phase now. So I think that has to me that's kind of another thing that's kind of blowing into their favor in terms of a tailwind as we go into 26 and 27, that heavy capex period that they've been in because of the 2G 3G roll off has kind of come to an end and started to dissipate.
Yeah, no, absolutely. And we kind of like those opportunities because the headline numbers are masked by factors such as that. But what we've always liked about the E-Road business model is that it is a hardware and software. So that hardware gets replaced every 5 or 7 years. But the model that E-Road adopt is that they basically provide it for free because they know once that hardware's in there, they've got the software license for the next 5 or 7 years, and then the way it's priced, the actual IRR they get from, or the average revenue or return of invested capital they get on every customer is as good as you'll see in any enterprise software business. But it's back end loaded, so that year one, year two, they're sort of behind the eight ball, but then they move into becoming very profitable. So Mark's spot on that the phasing out of that old technology had forced an acceleration of that, which was a cash flow drag for the business. But what it effectively did was reset the whole customer base with updated hardware, which um, is going to lock them in for another 5 or 7 years, and provide that certainty. So it is a really interesting tipping point, and it was more a legacy issue because they had that history in New Zealand where they had those 10-year plus customers that had the old technology. But that's not a dynamic they're going to face in the US or Australia. And they've got through it in New Zealand. So, yeah, very exciting. You talk about tipping points, and, it's, I think it's threefold for this company. It's definitely what Mark's touched on there around they've got through the rump of that refit of their hardware, which provides a lot of certainty and growth for the next 5 to 7 years. They've got this regulatory support in New Zealand around this road user charge, which again could 50% growth just on that alone. But North America's the sleeper here. Now, I say it with tongue in cheek, but our friendly US president has probably slowed down a couple of those opportunities in the US. In the scheme of things, all it's done is just the uncertainty around the tariff environment in the US put a lot of things on hold in North America over the course of this calendar year. Even we know the certain outcome now around the tariffs and relating to this particular product, and it will have an immaterial or basically zero impact on that. But it did cause a lot of large logistics companies to say, hey, let's just wait and see where this all lands. And these were 12, 18-month tenders they'd got through to the preferred supplier at contract stage, uh, and then were put on hold. My sense is over the next 3 and 6 months, you're going to start seeing a number of those contracts finally being documented, announced, and implemented. And that's the real next leg of growth that the market hasn't priced in yet, and could take it up another significant level. So that's the catalyst coming, I believe, in the next 6 months, that could really put this on the radar screen of every small cap manager in the country.
And maybe, can we just touch on their Australian business because they do operate here, but I mean I think it's, if I remember correctly, it's like an 80, $90 million revenue business in New Zealand, but Australia is like 18 or 20, it's like a quarter the
Correct.
despite the relative size of the economies, their Australian business is much, much smaller than their New Zealand and smaller than their US business. So, you know, why hasn't it got the traction here? Has it just not been a focus for them, or?
A little bit about the regulatory environment was a bit slower here in Australia, and they really only built out their sales channel and presence over the last 3 to 5 years in Australia. And these sales cycles, they're not going into selling a device to a retailer. These are enterprise sales. So you go into the Lynn Foxes, the old toll holding, like the big companies, and so you go in, you do a pilot, you prove the technology works, you prove the efficiency, and so they are quite long sales cycles, but extremely sticky if you land them. And so they're still in the early adoption stage there. And it was a nice reminder, Mark, unscripted, but I'd probably be not before, but another catalyst in this calendar year is likely to be a meaningful win in the Australian market with a larger provider. They are getting good growth, but if you look at, again, they're not going to get to 80% in Australia, but if they got to 20 or 30%, it would be as big as the New Zealand business, and again, a real leg of growth that the market's not pricing in yet. But again, I think they can land one of these big logistics groups in Australia, which management are confident they can do, and our own channel checks, independent channel checks, have indicated that they're well placed to as well. But there's no certainties in life, but we're hopeful that yeah, we can. You're going to see Australia becoming a more meaningful contributor as well.
Okay. Greg, we'll leave it there. If anybody wants to find out more about SB2, the LIC, keep an eye out on the ASX platform for announcements of. I know the NTA came out this morning, as we see here, Friday, August 8th, and like all the other microcap companies, you'll be reporting your own results in the next couple of weeks at the LIC level. So I'm sure there'll be a preso that'll be coming with that and a few updates on a few of the holdings.
Yeah, definitely. No, thank you again, Mark. I will be giving an update on a couple more of the portfolio holdings and the fund itself a little bit later in the month. And yeah, keep an eye on SB2 on the ASX there, and you'll get the details. But appreciate the opportunity to have a chat this morning. And yeah, let's see. We're about to get into the fun part of the year, right?
Mm.
Reporting season. Microcaps will all be the back end of August, but a lot of them are pre-released. But feeling quite optimistic that you know, with what's happening with interest rates, a bit more stability in the global macro environment and geopolitical, we touch wood might be in for a good run into the end of the calendar year for microcaps.
Yeah. No, we've had a good couple of months. We just must hopefully keep it going now. Greg, we'll leave it there. Thank you very much.
Cheers, Mark. Thanks all.